one of the members of the local organising committee, and I'm the co-director of the Australian Basic Income Lab, along with Troy, who you heard in the last session, and Elise, who've been hearing across, and you'll continue to hear across the conference. I'd like to begin by acknowledging that we meet on Aboriginal land, and as a matter of protocol and a mark of respect, acknowledge that the land was never ceded. Today we are talking about modelling and basic income. And it looks like I think we're going to have two papers because I don't think Bruno's here. So what I'm going to suggest is that we have each paper with some opportunity for questions straight after the paper, and then we'll move into a broader general discussion as well. It is a relatively short session, so I think in some ways this just makes it a little bit more, gives it a little bit more room to breathe, so to speak. So first off, I'm going to hand over to Geoff Crocker, who's going to present his paper on the macroeconomic case and impact of basic income.
How do I go that on the screen?
Initially there is. So do you know which one your presentation is?
I gave it to one of your guys there. And
it looks like it's on the screen.
It is on the screen, yeah, but you just have to tell me which one it is on each one.
One that says Geoff Crocker.
oh, yeah.
Geoff Crocker.
It's not a this is a fine presentation. I don't know what that means in German.
And then you can use, Geoff, you can use that afterwards. You should go forward and back from there.
This isn't working.
No?
No. They're sure me it would, but it doesn't.
Can I just have a quick play around?
Yeah.
I'm going to see if we can go. No, I'll go up the back, and if you just signal me, I will
Well, it's
change it.
difficult because it's line by line. Your guys assure me this is going to work. I want my money back.
I'll just ring you. I just need a bit of help with the IT. The clicker's not working for the
Thanks very much. We're on to it, but I'll do this until we.
and then,
So you're going to change the slides?
Yeah.
Okay. Well, it's line by line, so you'll just have to follow how I speak and kind of slightly precede me, so I know what I'm going to say. Anyway, thank you to the organisers of the conference and to the university for hosting us here. Thank you for the invitation to speak, and thank you for coming along to participate. So yeah, I'm Geoff Crocker, based in the UK. I've been working on basic income for the last 15 years probably, and focused on the macroeconomics of basic income, as I'll explain in this presentation. So yeah, please keep going. Please do it quite fast. So there are urgent macroeconomic reforms that are needed in our economies. And the first is that we need to get income to people. We need to get income to people in high-tech economies, because I will trace how technology is sucking income out of the economy, and that work and wage no longer provide adequacy of income for people, leading to extensive in-work poverty and leading to household debt, and that in developing economies, there's a need to get income to people to generate non-inflationary growth. Secondly, we need to get debt out of the economy, because we're in a model where in high-tech economies, debt to GDP is now well over 100%, in the case of Japan, 265%, and in developing economies, by contrast, the debt to GDP ratio is held at below 60%, which is inhibiting their economic development. So the best reform package for the macroeconomies, I claim, is a combination of basic income plus debt-free sovereign money. And I will try to explain what I mean by those concepts. Thank you in the forthcoming slides.
You should be able to use that.
Can I use it now?
Is it turned on? That was the other thing I was going to say.
Ah,
Yeah,
great.
there we go.
Sorry for that.
There we are.
Thank you so much, Steve.
So now the technology can put me out of work. So quickly, the case of basic income is in multiple dimensions. One is social justice, a very important issue for basic income, addressing inequality, addressing precarity, and sharing the inherited technology and infrastructure. This is a question of human ontology. This is a question of universal human rights. You know, we're born with access to sunshine and to sky and to sea and so on, and we're also born with access equally to the inherited infrastructure and technology that we all share, which should not be limited to an elite. And the second argument for the best welfare system, if you're going to have any welfare system at all, then basic income is arguably the best because it avoids poverty traps, it avoids unemployment traps, and it also minimises administrative costs because there's no conditionality. Ecology, basic income breaks the link between the only way to get adequate income is more work, more employment, more production, more output, and more environmental despoilation. So it has an ecological advantage and generally human flourishing. You know, if we're able to decide our own life pattern, what we do with every day, rather than 8 to 4 in a factory or 9 to 5 in an office, if the technology allows us a new level of living, then let's look at it. And but finally, in terms of macroeconomics, and I will argue that in terms of macroeconomics of UBI, there is both a macroeconomic case for UBI and there is a necessity to have a macroeconomic validation of the feasibility and the affordability of UBI. So I tried to summarize those arguments in that website there, which is called The Case of Basic Income at www.ubi.org. I've deliberately made that website unlabeled in the sense that I don't claim ownership of the website, therefore it's available as a general resource if you wish to make use of it. So I'd like to present a differentiated macroeconomic argument for UBI. One is that in high-tech economies, my claim is that technology and automation is sucking labour income out of the economy, and therefore you're finding increasing deficiency in people's household incomes, and that UBI is necessary to supplement those declining real incomes. For example, you see that real incomes have flatlined in the USA for the last 30 years, and people have been forced into debt to supplement them. And secondly, in developing economies, that as I will show in a slide in a moment, the debt to GDP ratios are so constrained that they don't allow income to be fed through to people for growth. So that in a developing economy situation, a UBI, I will argue, will generate Keynesian growth, which previously was thought to come through government expenditure, which then created a multiplier in waged income. But now, in this proposal, would be more direct income to people with lower incomes. So in both cases, I will also argue that UBI should be funded by debt-free sovereign money. And I keep promising, but I will explain it. Here is a slide which tries to show the structure by which technology and automation in the top left there is, number one, sucking income out of the economy, number two, bifurcating employment into very high-paid executive jobs and very low-paid manual and ordinary so-called bullshit jobs, so that inequality is rising not only between those who are employed and those who are not employed, but also within those who are employed. And thirdly, that reduces, therefore, labour bargaining power. Households get forced into debt, governments get forced into taking on more debt, and then the whole system collapses because it's overridden with debt, which is what happened in 2007, 2008, leading to austerity policies, which I would also argue are unnecessary. This graph tries to get into the empirical evidence for those claims. This is a graph of the UK economy from 1948 through to 2016. And what you see there is that consumer expenditure used to be less than labour income, i.e. labour income was enough for people to buy what they wanted to consume. That changed in 1995, since when consumer expenditure has been in excess of labour income. So I claim that that's some empirical evidence justifying the claim that technology is sucking income out of the economy. And we've researched that at the Institute of Policy Research at the University of Bath. We've got now so far a 4-year project and got another 2 years to run, in which a multi-country econometric study, which has regressed data for 23 country economies, has demonstrated that indeed the technology variable is responsible for the decline in the labour share in the economy. And there's a link there for any of you who would like to look at that report in greater depth. Coming on to the claim in the developing economies, here's a graph where up the y-axis is GDP per capita, i.e. what is the income level in the country, and on the x-axis is the debt to GDP ratio. And you can see there fairly clearly that developing economies who have low GDP per capita also are constrained by low debt to GDP ratios. So World Bank and other international organizations insist on maximum 55 to 60% GDP to debt ratios for countries like Malaysia, constraining their ability to have higher income per capita, whilst totally hypocritically, the developing economies are running at anything from 100% up to 265% in the case of Japan. So the claim here will be that debt to GDP ratios are unnecessarily restricting economic growth in developing economies. And there's a bit more text about that. So what would be the answer? Either we relax the debt to GDP ratio so that it can approach that of a developed economy, or we say that money can be created to fund basic income without that money having to be calculated or accounted as debt. Here are the questions of funding basic income. So the revenue neutral proposals, which are common in microeconomic simulations, fund any expenditure on UBI in terms of tax reductions, tax increases and benefit reductions. Now those packages have to be very carefully attuned because it depends which taxes you decide to increase and which benefits you decide to reduce in order to produce an outcome which is beneficial, i.e. is more redistributive and more progressive. Wealth taxes are often proposed, we've heard them at this conference. My concern and worry there is that it's actually very difficult to manage the combination of assets that people have calculated as wealth. And in fact, if you do tax wealth, in reality, you're taxing income. You're taxing the income of the wealth holder based upon a wealth parameter. Land taxes are proposed. My worry there is that some of the most profitable companies in the world, the FANG economies, the Facebook, the Amazons, the Netflix, the Googles, they're the people with the biggest profit, using almost no land at all. So that a land tax would not capture some of the high incomes in the corporate world. Eco-taxes, my critique is, eco-taxes are there to actually reduce pollution, not to raise revenue for something else. So I'm going to explicate the idea of sovereign money creation. But funding basic income, we've got to get over this challenge that the UBI is either too small to be meaningful or too large to be affordable. So here are some reasons why basic income needs debt-free sovereign money in order to be viable. One, that it is actually, I claim, the only way to deliver adequate basic income at an affordable cost. Two, that it is a consistent argument for basic income as for debt-free sovereign money. So if we take a thought experiment of a totally automated economy where you could plug a machine into the earth and it produced all the goods and services you wanted without any labor, so it's a thought experiment, right? In this thought experiment, there are no wages, but there's plenty of goods and services. How do we distribute them? Well, the government would have to give vouchers to people to go and buy what goods and services they wanted, destroy the vouchers when they're handed in, and then distribute a fresh set of vouchers the next year. It's a thought experiment. In this thought experiment, 100% of the economy becomes basic income, and 100% of the economy is funded by the vouchers, which are debt-free sovereign money. Okay? So that will never quite happen. But my nuanced argument is that to the extent there is automation in the economy, to that extent we need a basic income and we need debt-free sovereign money. And the other issue is that in this, in the COVID economies that we were discussing in the last session, we've actually seen very significant household incomes paid out. So in the UK, 3 million people were paid £24,000 a year, costing £69 billion, all of which was funded by the central bank buying government debt. And the 69 billion was part of, indeed, 875 billion, which the Bank of England bought of government debt. The claim then is that since the central bank is owned by the government, actually that's not debt at all. It's one arm of the state, if you like, owing another arm of the state. And basic income and debt-free sovereign money then tackle these joint problems of getting income to people and getting debt out of the economy. And here's some more empirical evidence. So very familiar graphs, but that's UK household debt mushrooming between 1987 and 2021. This is a UK national debt doing the same thing. Here is EU national debt with the EU 27 average at 90% of GDP. And this is OECD data. So in all those cases, you see very substantial debt arising in the economy, both at household level and at government level. So how do we engineer debt out of the system? We've got to find some way of replacing household debt with basic income. And we've got to find a way of replacing government debt with debt-free sovereign money to enable us to restore austerity cuts.
15 minutes.
Sorry?
15 minutes.
Have I done 15? Oh God, I've got to be quick. So redefining money. We've got to redefine money away from very traditional orthodox concepts that money has inherent value and that government financial balances determine the affordability of anything, to the Keynesian definition, when Keynes famously said, anything we can actually do, we can afford. And that requires us to go to a heterodox theory of money where the state can actually issue money subject to the GDP output constraint. I'll have to rush in that case. This is a graph, a slide I won't go into in detail, but it does look at three different definitions of sovereign money. That proposed by the MMT school, enunciated by Weinel, Ray, Stephanie Kelton, which regards money still as debt. And that debt is balanced by other surpluses in the economy. And the definition by Joseph Huber, that sovereign money means that only the state can issue money and not commercial banks. And my definition, that commercial banks can still issue money, but the government issues money which is not then counted as debt. There are academic papers out by Michael Kumoff and others making the same claim, that money is not quintessentially debt, either legally or in accountancy terms. And this is some recent research by Cambridge Econometrics that we've just worked together on and published, which takes a macroeconomic model of the UK economy, a multi-sectoral model, and feeds in £100 billion of basic income, aggregate, funded by £100 billion of debt-free sovereign money. And if you're able to look at that report, you'll see that the results are that it produces a stable equilibrium. And furthermore, what we've been able to do is to simulate the effect of more labour income coming out of the economy through a big slug of automation, putting that back in with basic income, and again funding it with sovereign money, and again showing that there is a stable equilibrium. And there's the link to the project. We're about to report in Q1 of next year on a similar model that uses a stock flow consistent model of the economy with a specific financial sector. That's for the economists of you here. But don't worry if that's... I won't go through this, I obviously don't have time in any detail, but the way in which government money is currently generated and the way in which a central bank buys government debt, the rule in most jurisdictions is that the central bank can only buy government debt in the secondary market, i.e. it cannot buy it directly in the government's sale of its debt. The result of that is that those who trade in the primary market, the stockbrokers, insurance companies, the pension funds, the rich individuals, the foreign central banks, make huge gains on their purchase of government debt. Huge gains in terms of the value of their portfolios and huge gains in terms of the sales margins they achieve when the central bank goes in and buys in the secondary market. That, in my view, is a scandal, and it involves big money. So in the UK, we're talking about the 875 billion of government debt bought by the central bank, with intermediaries making excess profit on that. So the reason that life without government bonds is better is that it eliminates this myth of a national debt greater than GDP. It eliminates the debt servicing cost. It enables necessary income to households and eliminates crisis and austerity. I guess I've run out of time. Inflation is only a problem if we exceed aggregate total demand. We have to observe this rule that all demand in the economy must be less than output GDP. And I've already said this. And this is a final beautiful system where output GDP enables the creation of debt-free sovereign money, funds government welfare, funds a basic income, gets rid of austerity and crisis, reduces poverty and inequality, and increases the ecological and human outputs. And finally, there's my book, which I can present to you without any conflict of interest because I get no royalties from it. And thank you very much.
Are there any quick questions for Geoff? Yeah, up the back.
Yeah, so when you're talking about debt-free sovereign money, do you consider, is that a full replacement of all treasury bonds? What about reducing the number of treasury bonds? Because the modern monetary theory school generally says that the purpose of government bonds is to promote the stability of the value of the currency. So maintaining some treasury bonds might be a good idea for maintaining the stability of the currency.
In what way do you think a bond maintains the stability of the currency?
Because you end up with a guaranteed return of a certain amount of percent in the future, and it also prevents bubbles.
Yeah, well, I mean, they're obviously, the central banks are intervening in the secondary market, as you say, in order to either maintain the value of the bonds or to reduce the value of the bonds. And generally, they're wanting to increase or maintain the value of the bonds in order to keep the yields low, so that the interest rates in the economy are low. So in terms of interest rate, yes, you need to keep doing that. But I would still argue that the central bank should either be allowed to participate in the primary market, so there aren't all these intermediate profits made, or they should just be allowed to issue debt-free sovereign money. Yeah, so that's
one from Carl up the back, and then we'll have more questions at the end, but we're going to go on to the other paper.
Hi, I don't know if you can answer this in the time we have, but most of the people that I read who use the concept of sovereign money also believe that UBI would necessarily cause hyperinflation no matter what the tax policy. Clearly, you don't believe that. How what is the causal reason why they get this result and you get this other result, both out of the same idea of sovereign money?
Yeah, well, I mean, there is a big divide in the sovereign money reform movement between the formal MMT school that's led by Randall Ray and by Stephanie Kelton and people whom I have great respect for, but they insist that A, it should be debt, and B, it should be used for job guarantee rather than for UBI. And, you know, I try to have correspondence with Randall Ray. He told me, he says, UBI is a right-wing plot against job guarantee. He told me, oh, well, he said, come and get an education at the Levy Institute and then I'll talk to you. So, I mean, it's very difficult to engage with some people in the MMT school because of that.
I know.
In terms of why they say it would cause inflation and why I'm claiming it doesn't. I'm claiming it doesn't for two reasons. One is a modelling reason. So in this Cambridge econometrics model, we found no inflationary result. The reason for that was the first injection of UBI took up slack in the economy. The second injection of UBI then worked through the full econometric model and fired the investment function, fired the production function to ensure that there was production to sustain the UBI generated demand. And thirdly, practically, as I said, the recent furlough scheme, the 69 billion injected into the economy into incomes, did not produce inflation and did not produce devaluation. So the scare stories have been proved wrong, in my view.
Okay, thank you very much, James. No worries. Thanks again. So, our next paper by Bernhard, Neumärker, and Jette Weinel is on the implications of UBI on utility functions and tax revenue. And is it possible to get I might do that. I'll set that up while you.
How does this work?
So you just have to go forward. Yeah, that's all. So I'll just set them up. Make sure. We just need the next presentation.
Yeah.
Okay. Hi everyone. My name is Jette Weinel. I work at the Bernhard chair at the University of Freiburg. I've done my bachelor's degree in economics at the University of Freiburg, and I'm now currently doing my master's program in applied economics at the University of Vienna. Our presentation today is about the implications of UBI on the utility function and consumption tax revenue. Let me quickly start with giving you an overview of the structure. So in the first two parts of the presentation, the introduction and the paradigm shift, I will present to you the basic idea and our basis of argumentation, to say so. Then I will discuss the results of our theory in a simple static economic model. We next provide a numerical example, which I will hopefully have the time to discuss a little bit more in detail. And conclusion and outlook then consists of a brief summary and of the outlook on our next step, as we are still at the beginning of our research project here. There we go. So, introduction. So, we argue that economic modeling of the UBI actually does not account for how individuals' utility calculation changes as a result of the UBI, and we aim to overcome this blind spot by characterizing a utility function adapted to the UBI. So while the additional separable relationship between consumption and labor is the basis of mainstream fiscal thinking, and in theory and practice, the utility calculation of an individual socialized by the UBI is reflected in our view as a multiplicative relationship. We argue that this change is due to time sovereignty that individuals gain through UBI, which in turn enables them to be self-determined, creative, and intrinsically motivated. Here we are actually closely related to the work by King and Rivelot, who have developed a multiplicative utility function in 2000. So the second part of our presentation then considers the consequences of the UBI utility function on tax revenue. Therefore, we explain the consumption tax revenue within UBI, in the UBI system, so to say, and with multiplicative preferences, and a means-tested welfare system with additively separable preferences. Here we are closely related to the work by Trabant and Ulik and Hiaraga and Tahara. So Trabant and Ulik have shown in 2011 and 13 that the consumption tax revenue of the multiplicative utility function is actually does not peak, so is monotonically increasing. And Hiaraga and Tahara later added to that research by showing that the consumption tax revenue curve is actually sensitive to the utility function. The paradigm shift. So what do we mean by the paradigm shift? As the principal action theory shows, the utility relation, the conventional utility relationship between consumption and labor, it shows how we think individuals behave on the labor market. This is because the principal hires an agent to complete a task, but the agent himself acts on her own best interests, which are contrary to the principal's interests. So in a state of asymmetric information, moral hazard occurs. So then when modeling the agent's utility, it is therefore modeled as an additively separable utility function, where the agent divides her time between labor and consumption, where labor provides a livelihood and consumption. But the agent shows the well-known disutility of effort because she dislikes her work and suffers while working, which is, as you see, kappa, so the small k. This utility of effort, however, is the main driver of labor supply in the traditional household supply and aggregate labor supply market, aggregate labor market supply function, and results in a utility function in which the utility is derived from consumption minus work suffering multiplied by work, as we can see on that slide. On the other hand, the idea of an UBI for every citizen in a society being based on the understanding that humans have intrinsic motivation and prefer time sovereignty as an essential part of liberty to the conventional consumer sovereignty and strive to be a productive part of the society, it breaks with the principal agent approach for the labor market. This actually means that the individual is now no longer obligated to take on work suffering in order to secure livelihood, but as I said before, it's rather about being free and self-determined in one's decision when it comes to work. So, hence, when someone receives such a transfer, it will automatically change its utility calculation. So the utility function with respect to the UBI considers not only time sovereignty, but also the resulting intrinsic motivation to work, which in our approach is integrated in the function with the parameter rho as an intrinsic value and time sovereignty, as I said before, being the multiplicative linkage between consumption and labor. So to sum it up, we basically argue that there must be made a distinction between the preference relation socialized to a means-tested social security system and one to the UBI. So the model, as I mentioned, the second part of the presentation is concerned with examining the tax effects. For this purpose, we have a simple static economic model in which only one tax is imposed, the consumption tax. Nevertheless, we are currently about to apply different tax schemes and see how the model does, but this is for later on. I don't want to say too much about this because it's just a very simple, easily explained model. So let's get to the means-tested system. In this model, with the additively separable means-tested utility function, leads to the following results. As you can see on the slides, the tax revenue corresponds to the Laffer curve in which the revenue is maximized at a certain level. This is here tau C. The unconditional basic income in this model actually shows us some other results where the consumption tax revenue curve does actually not peak as long as lambda, which is the inverse of the labor supply elasticity, is greater than 0. So even though we do acknowledge that this is just a very, very simple economic model, the results are very interesting when it comes to questions around financing UBI. So next we provide a numerical example. You see on the X-lab the tax rate and on the Y-lab the tax revenue. Let me quickly give you an overview of parameter values. So the constant relative risk aversion that we set here, eta is set to 0.71, even though the behavior towards risk in this model is obviously not relevant, but it can be understood as a parameter to kind of shape the utility function, or as an indicator of the shape of the utility function. The labor supply elasticity is given by 1 divided by lambda, where lambda is set to 0.1. And when it comes to estimates in the literature of intrinsic motivation and weight of labor in the labor market in a UBI context, we found actually that the literature is lacking there. So we refer for the weight of labor, which is kappa, to Tarant and Ulik, who have estimated the weight of labor for the US and Europe and set kappa to 3.46. And the intrinsic value is here based on a study by Capillari and Turati in 2004 and is set to 0.8. So we can see a strong difference in tax revenue between the means-tested system and the UBI system. And on the very right graph, you can can see how the tax revenue curve for the means tested system is actually decreasing. So shows us a little bit of the left curve shape, even though it's not really shaped on that, at least on that plot. And while the UBI tax revenue curve is increasing. So this is perhaps the more interesting slide, I would say, as we are now looking at the difference in tax revenue that arises through the time sovereignty effect and the intrinsic value. So following our argumentation, the time sovereignty effect arises through the multiplicative linkage between consumption and labor in the utility function. So this effect is actually the difference between the linkage. So we see that the intrinsic value is less than the time sovereignty value when it comes to the effect on the tax revenue curve, but still they're both quite strong, I would say. So, and on the other graph compares the three different functions. So we are here seeing the difference that arises through time sovereignty between the implicit system and the originally multiplicative utility function by King, Revelo, and Blosser, which can be then interpreted as the time sovereignty effect, and then the difference between the King, Revelo, and Blosser function and our UBI function, which then shows the effect that arises from intrinsic motivation in the utility function. So this is, from economists, I guess, quite counterintuitive, but actually shows us, at least in the simple model, how considering the effects of UBI in the utility function actually has a positive effect on the tax revenue curve of the consumption tax. So, yeah, to conclude, let me just give you a brief summary. So, first of all, as I said in the paradigmatic, one needs to account for the change induced by UBI in economic models. As we argue, additively separate order preferences represent a means-tested system, while the multiplicative utility function represents a UBI system. And then the UBI consumption tax revenue is increasing while the means-tested consumption tax revenue peaks at a certain level. So accounting for intrinsic motivation and time sovereignty has an effect on the consumption tax revenue. And this is our outlook for the model. So what are we doing? What are our plans now with this research project? So first or next, we're currently applying different tax regimes in the model to ask the question of which level of UBI can actually be funded in different systems. So the first step would be the integration of labor income tax, and then earmarking consumption tax to the UBI in a mixed system. Then another step would be integrating heterogeneous agents and adding the constraints of new order liberalism. We can actually have a lot of things that you can do with the model and how you can evolve it. One big question is how to integrate volatilism into the utility function without the utility function getting too complicated. And then even ask about the different governance regimes and all these kind of things.
15 minutes. You've got a couple of minutes, 15 minutes.
Perfect.
You still have time?
Yeah, like two minutes to go, that's what I was saying. But if you stop, that's fine.
Yeah.
Perhaps I should, I could add two things, because here one needs to account for behavioral changes. This sounds perhaps natural or not, if you believe in the model or not, but the consequences are tremendous. For example, as as Geoff mentioned it, that some simulations are based on revenue neutrality. Yes? If you base your simulation, what is usually done on an additive separability model, yes, and you compare then this one, yeah, with a system without basic income, yes, because you still assume additive separability when you simulate tax revenues. That's wrong, because with you see a lot of lower tax rate, yeah, you can receive in a basic income system the revenue neutral tax revenue, yeah. So all these measurements are wrong, yeah. That's very important to adjust it. Whenever you have the paradigm shift due to basic income, then the tax revenue increases more than under the old system. And this means it's more easier to finance basic income in that respect with the consumption tax. Why we have chosen the consumption tax? Because the labor taxation, the wage tax, the labor income taxation still shows the level curve. Only the consumption tax doesn't show it. Last remark, due to macro simulations, very often macroeconomists also apply additive utility function when their macro models are based on a microeconomic foundation of the labor market. Then they make the same mistake. Therefore, you see our model is an attack even to models of basic income promoters, because they measure their effects in a wrong way, because they do not take into account in their models time sovereignty and also not the aspect of intrinsic motivation, which is really elementary to show it explicitly in the simulation and in these respective incentive effects. If not, then you make big mistakes in your estimations. Thank you very much.
Thank you. Wonderful. So we might just focus on this paper. Thank you very much. Do we have questions here? Yeah, thank you very much, Scott.
I'm curious, could you go back in the slide to the slide of the equation for coming up with the value of the tax value?
This one?
It might
Do you mean
be
the utility function or?
either that one or a previous one, whatever had the equation for, kind of like the final kind of conclusion equation. I don't think it was that one, but it's one closer towards the end. Yeah, maybe it's that one. But anyways, my question is because you have an equation that you've developed from this model, do you have, even just like a simple website where you can like plug in, like, this is the consumption tax, this is the amount of UBI, and this is, as a result, it would spit out the amount of revenue that would come from that model. But if not, like, could you do that pretty simply, because that's what you developed? You developed an equation from this model, right?
Yeah. So we don't have that yet, but I think it is pretty easy to develop such a website. But you need to consider that this is just a static.
Sure. But I'm just curious because you have all these, like, for the most part, most people look at this I'm the same person, and I'm looking at this and it's like, it's all just some foreign language. I don't understand any of this.
I know.
But like, it would be helpful to be like, here's an example. So like, here's a 10% consumption tax with an amount of $1,000 per month of DBI, and then here's where most people think that the revenue is, and then here's where our model says that this is, and you can even show like this is how people are off in the assumption.
I think it's pretty easy in the model to design such a website. Even though I think still you would all need all those parameter values for your specific case, which might be a little bit difficult, but that's a good point. I think make it more visible and not, have all these equations
Right.
all over the place. Yeah.
Any other questions? Okay. Do we have any general questions for the whole of the session for any of the presenters? Oh, yeah.
So I know it's a static model at the moment, but are you looking into the future of potentially looking at how it could change over time?
Yeah.
Just in the context of what Basic Income Australia, we propose a gradual introduction of a basic income as taxable income over time, which sort of gracefully phases out the means tester system, depending on what means tester system it is. We'll keep some in place, others not. And it's sort of, it would be really interesting because we agree with you in terms of like intuitively how that would work, how you guys have set up these assumptions. I think that we've just, made pretty rough guesstimates at how much we might potentially be able to recover from additional tax revenues. It would be really cool if we could have a little bit, if you'd be interested in looking at being able to apply that would be.
So these are, I guess, some of the next step, transferring it into a dynamic model, applying heterogeneous agents, all those kind of things that makes us a little bit more applicable, to say so. That makes sense, yeah.
First of all, we are concerning this. We are very interested in cooperation. Why? Because, for example, these elasticities, these are only 3 elasticities in the dynamic model. We need a 4th one, but we can then also integrate capital taxation, which really erodes. Very interesting. Capital taxation decreases immediately. It's very interesting. It shows no lever. Yeah? When the consumption tax rises, capital taxation decreases, and the labor tax seems to have a short peak and then also erodes. Yes. Therefore, we started with consumption tax because these other authors showed that the consumption tax is the only one who has the option to increase also in a dynamic model. And in principle, when you see our time sovereignty utility function, the reason is very clear, because for a time sovereign individual, more or less, and now capitalists will put me into the left wing corner immediately, because all what you do in your life is consumption. Yeah? Consumption on the job, consumption of goods, yeah, and so on. This means in the end, the disutility of labor as an opportunity cost still does exist. It also exists in the model, as existed the opportunity cost of consumption. The next best employment of your money. Yes, these opportunity costs still exist, but you are completely time sovereign in such a model. Yeah, and therefore it would be really interesting, because you said, could we give something at hand if we would have on a homepage the elasticities for Australia, the elasticities for United States, the elasticities for Portugal and Germany. Everyone could put this parameter in and then simulates over the consumption tax rates to see what tax revenue generation is possible for different countries. And that would be very interesting, because then the potential for a maximum basic income in different countries is also different with respect, say, to this intrinsic motivation, intensity, and time sovereignty intensity in different countries, which might be culturally different. So a very important question, but you see, there would be a lot to do.
Next question.
Hi, I've actually got a question for Geoff. It's about this wonderful graph you've got that shows wage income being overtaken by consumption.
Yeah.
And I know your explanation for that is technology, and I'm certainly not saying that's not a factor. But I wonder if perhaps globalization is also a factor, because there's been technological progress for all of the decades leading up to the 90s as well. and something that happened in the 90s. I know Australia better than the UK, but I think it was fairly widespread across the OECD. Was that a lot of tariffs got removed, and a lot of manufacturing jobs, which are a job where people have a lot of labor power, labor has a lot of bargaining power rather, went to the third world, where people have very little. So is it not possible that cross-border wage competition is at least a contributing driver to this? That's what's sucking money out of the developed economies.
Yeah, no, I think that's absolutely correct. And I mean, the main argument, if you like, going on amongst UK economists is whether that phenomenon is due to technology sucking the wage out of the economy, or, as you say, a reduction in labour bargaining power. And therefore, that leads to different policy remedies. So those who think it's reduced labour bargaining power think that strengthening of the trade union position would therefore correct that. Those who think that technology is the main cause think that even if you had the most powerful trade unions out, you couldn't stop the effect of automation in reducing wage labour in the economy. So the model that we ran at IPR Bath, this 23 countries cross-sectional regression, did test all of those factors, including, as you say, globalization factors, financialization in the economy, and so on. And there's a full report on which factors prove to have the most explanatory power. And so globalization does have an explanatory variable, but the main issue coming out of it was that technology was the best explanatory variable. But yeah, I agree, you're absolutely right. There are various causes. And even with an econometric model like that, there are still finesses as to which variables you measure and whether you find that globalization has a larger coefficient. But it's certainly one.
Yeah, just one quick follow-up on that is, my concern is that then if you introduce a basic income in the UK or Australia or a developed nation, you actually increase the competitive advantage of countries with cheap labour because by increasing labour power in the developed world, you make it more attractive for employers to offshore that labour. So I'm certainly not saying that's the only thing. I've had a job that's been automated, so it didn't get offshore, it got automated. So I know that's a real thing. But the danger of increasing that international inequality then favours that strategy of offshoring and further reduces.
Well, because you think if the UK, for example, introduced a basic income, that would make UK less competitive.
It would make workers in the UK less desperate. It would make workers in the UK less desperate and give them more of a capacity to demand higher wages. Meanwhile, workers in Bangladesh, for example, don't have a basic income, already poor to start with, and you've compounded that inequality, which is described by by some economists as comparative advantage. Our comparative advantage is we have desperate people who will work for nothing.
Yeah, I mean, as you say, but the jury is slightly out, really, isn't it, on what the effect on the labour market would be of a UBI. We know in the Finland experiment that it didn't change participation rates very much, if at all. But whether it leads to people being ready to take less wage because they've got a basic income, or feel more secure their basic income, and therefore have the power to argue for more wage. I mean, those are very difficult questions to answer. I mean, I actually think, as a final point from me, I think the case in China, actually, for a basic income is very strong, is slightly differentiated, because currently, as we all know, China is producing commodities for the rest of the world, and therefore it has a productive potential, but it's exporting, for example, to the USA and funding the US consumer by buying US Treasury bonds. And my argument to the Chinese government would be, why do you do that, Why, instead of buying the US Treasury bonds to fund the American consumer to buy your Chinese product, why don't you buy a UBI in China and direct the same product to your own population? So I think they have a unique and very strong argument for a UBI in China. And, it's very difficult to get a discussion going at the moment with Chinese academics because they are constrained politically as to what they're allowed to say, under the present government restrictions. But I think they've got a strong argument, and I wouldn't be surprised once you see, digital currency, government digital currency in China, you see a UBI come forward.
Okay.
Just a really quick question.
Very, very quick, because we've
Yeah.
got another session starting.
Have we done, or can you do, a more extended version of that presentation? like a 50-minute thing? Because that was not enough time.
Yeah, I thought I would have 25 minutes,
But
I'll
like-
have 15. So
Is there one online that we can look at? Like
yeah. If you go to that website, ubi.org,
Yeah.
You'll find a presentation on there and also the written slides as well as spoken to slides.
Right.
Yeah, I'm sorry I had to go so fast, but you blame the hosts.
It's a nice little right-hand jab at the end, isn't it? Thank you very much for both those presentations and for a wonderful session. We're about to go straight into another session now, which will start in about a minute. So if anyone needs to grab a drink or please back to the lead, you've got about 90 seconds while we switch over, and then we'll get back into the next session. Thanks very much.
Well, it's good that Bruno